Hello, and welcome back to our final lecture portion of dealing with investments in corporations, right? So, for the purpose of evaluation and reporting, that's what we're going to get into in this video, right? So, we're going to explain how to report in the financial statements both debt and stock investments. Okay, so we need to recognize first that when we're reporting and as well as evaluating the financial statements, debt and stock investments are classified actually into three categories. Okay, so looking at debt investments, right? We have what we call trading securities. We have what we call available for sale securities, and we have held to maturity securities. Now, you need to know what each of these mean, okay? When we're talking about trading securities, these are securities that are bought and held primarily for sale in the near term to generate income on short-term price differences, okay? So think, and I'm sure you guys are familiar with penny stocks, right? I don't know if I don't think this is that as popular as it used to be, but people would trade penny stocks, right? And penny stocks would be an example of trading securities, right? We're buying them, we're holding them for the simple purpose to sell them in the near future to capitalize on some short-term price differences, okay? We do the same thing with bonds, right? We can do that with bonds. Available for sale securities. These are securities the companies may sell sometime in the future. We might not, right? The intent here is that we probably will sell them eventually. Then we have held to maturity securities, right? These are securities that are debt securities, and the intent here is to hold these to maturity, okay? Now, I'm sure a bunch of questions are racing through your head right now. How do I know to classify which one? You don't. Okay? You need to look for some more information. The key information you're looking for is, what is management's intent? Is management's intent to hold this for the short term and just capitalize on the price differences from day to day, or maybe from hour to hour, or minute to minute, whatever? If that's their intent, you report it as a trading stock. Available for sale, right? Notice we didn't say we're going to sell them or we're not going to sell them. We just said that, we're going to hold them. They're available for sale, right? Company may sell them some point in time in the future. Doesn't matter when that time is. There is no guidelines that says, hey, if you hold it for X amount of time, you have to change how you're going to report it. No, it's just based on management's intent. Management intends that they're going to sell it sometime in the future. Then there's held to maturity securities. Again, the intent is that management intends on holding them, and they also have the ability to hold them to maturity, right? Think of held to maturity accounts as kind of like a retirement account, right? I'm going to hold this. I'm going to have a retirement account. I'm going to put money into it. I'm going to invest in it for the sole purpose to have hopefully cash in retirement, right? Have money in retirement. Same kind of concept with held to maturity securities, right? The company intends to hold them till they mature, right? That's the intent. Could a company sell a held to maturity security? Sure, right? They could in the future. Again, it's all on intent. If management doesn't intend to sell them, but something happens and they need to sell them to get cash, they can do that, okay? When we're looking at equity investments have two types of categories: trading and available for sale, right? Trading means I'm trying to generate income based on the price differences on the stock, whether it's day to day, hour to hour, whatever. Available for sale means the same thing. Securities management's intent is, yeah, I might sell them sometime in the future. I don't know. Okay. Keep in mind that these categories of securities that we're talking about and the classifications of debt and stock investments apply to the debt and the stock investments in which holdings are less than 20%. Okay. Again, we talk about trading securities. We mentioned that. Let's look at an example of how do we value each of these securities. Okay. And how do we value those? Well, it depends, right? If we're looking at trading securities, right? Remember, what does trading securities mean? It means that we are frequently buying and selling these stock to generate small amounts of income, okay? On the balance sheet, we have to report those at fair value, okay? So each time we do a financial report, right, each quarter, at the end of each year, we have to calculate the fair value of all the stocks, bonds, whatever that we have in these in this investment account, and we have to report the changes in the fair value. Okay, and we report those changes in actually our net income. Okay, on our net or on the income statement. Available for sale securities, right? How do we report those? Well, again, fair value or available for sale securities are reported at fair value, right? So we need to change the value of those shares that we have whenever we report. Now, when we're looking at available for sale securities, right? Any changes are reported in the stockholders' equity section. Write that down. Okay? At available for sale, reported at fair value. Changes reported in the stockholders' equity section. When we're talking about trading securities, reported at fair value. Changes are reported in net income. Okay? Held to maturity, well, we have to amortize those costs. Okay? What else we have here? Okay, so here's an example of, so we talked about how do we report? We report at fair value if we have trading or available for sale, right? Where we report that differs, right? Trading securities reported at fair value, where they recorded at income statement. Available for sale, what are they reported at? They're reported at the fair value. But any changes in value is reported in the equity section. Okay, so what does that look like, right? So let's look at the example here, right? Cost and fair values for investments of Pace Corporation, right? They have the following, or classified as trading securities on December 31st, 2017. So as of December 31st, 2017, this is their trading securities account, okay? Notice what they do. They it looks like they have two investments here. Yorkville Company and company bonds, and they have Kodak Company stock, okay? So both bonds and stock, it doesn't matter. What matters is how are we classifying it? How we're classifying it dictates how we report it, okay? So these are trading securities. We report the cost, right? The cost was $50,000 for the Yorkville bond, and the Kodak Company had a $90,000 cost to it, okay? As of December 31st, 2017, since these are trading stocks or trading securities, we need to report them at the fair value. So we calculate what's the fair value at this date. Yorkville Company bonds, it's valued at $48,000, okay? Kodak stock, Kodak Company stock, the fair value is $99,000. So we have what we call an unrealized gain or an unrealized loss. The reason why it is not realized is because we didn't sell them, right? We still hold them. Our intent is to sell them. They're trading securities. However, we hold them at the end of the reporting period. We need to report. We didn't actually sell them yet, but this is the unrealized gain or loss that we would recognize at this point in time if we were to sell them, okay? We compare the difference between the two, right? In other words, we net out the unrealized gains or losses from all the investments that we hold. So we see that we have a total change of $7,000. We have an unrealized gain of $7,000. What's the adjusting entry? Well, I need to report the adjusting entry, or I need to record the adjusting entry. To do that, I'm going to debit fair value adjustment trading account, and I'm going to hit unrealized gain income for $7,000. Okay. Again, available for sale securities. We talked about this, right? These are held with the intent to sell sometime in the future, right? Very important. How do we classify these? Well, they can be classified as current assets, or we could classify them as long-term assets. Okay. Again, how do you know which one should it be available for sale? Should it be a current or should it be a long-term asset? Again, how do you tell? You don't. You have to ask management, or the problem will tell you management's intent is to sell these within the next year, or management's intent is to sell them 2 years from now or 3 years from now, okay? Again, they are reported at the fair value, right? Just like we mentioned before, any changes in the cost, we have to report them in the stockholders' equity section. Again, we do that as either unrealized gain or loss. Let's see an example, right? We have available for sale. We have a Campbell Soup Corp bond, and we have a Hershey Company stock. Again, these are securities. I don't care if it's bonds or stocks. It's based on the intent. Our intent is to hold these for sale. Cool. What's the journal entry that I need to do? Well, we need to first calculate the changes based on the cost and the fair value. And if you notice here, you see that we have a unrealized loss of $9,537. Why is it unrealized? Because we didn't sell anything yet. If we would sell them, this is what we would have. But we want to give investors enough information. Oh, by the way, based on our investment account, we have an unrealized loss here of $9,537. Cool. What's the adjusting entry? Again, because it's available for sale securities, we have to report it on the shareholders' equity section. So we have to debit unrealized gain or loss equity, $9,537. We credit fair value adjustment. Notice it says AFS. That means available for sale. Okay. Don't worry about the do it. Excuse me. The do it part, because we're going to go over some examples here in a second. Real quick, when we're looking at the balance sheet, right? Because we got to put together the balance sheet. The balance sheet presentation, it's going to say short-term investments, okay? Those short-term investments, we also call them marketable securities, right? Again, these are securities that are held by a company, okay? They are readily marketable, meaning I can turn around and sell them whenever because there's a market for them. And these short-term investments have an intent, right? What's the intent of short-term investments? To be converted into cash within the year of the operating cycle, whichever is longer, okay? So keep in mind that when we're talking about these investments, or any investments that don't meet or don't meet actually both of these criteria, meaning they have to be readily marketable and they have to be intended to be converted into cash. If they don't meet both of those, we report them as long-term investments, okay? Trading securities, almost always going to be classified as short-term. Available for sale securities, well, we have to look on what's the management's intent, okay? When we want to present the realized and unrealized gains and losses, right? What goes under each category? Well, we're going to bring it all together because we already talked about it, right? When we're looking at other gains and losses, things like interest revenue, dividend revenue, gain on sale of investment, and unrealized gain income, those are under the category of other revenues and gains, right? Other expenses and losses. What falls under that category? Well, obviously, losses on sale of investment, as well as unrealized loss income, right? Why are we saying income? Because those are trading. When we see that income, we know it's trading securities and we know it's reported on the income statement. Okay. Now let's look at the unrealized gains and losses on the balance sheet. Remember, what do we report the fair market or fair market value changes of? What classification? Available for sale securities. Okay. And again, we have to report these unrealized gains or losses on the available for sale securities within the stockholders' equity section, and it's reported as a separate component. Notice what we have here, right? We have stockholders' equity. That's the category. Yep, you know that. What falls under there? Well, common stock. Yep. Retained earnings. Yep. Then we have the total paid in capital and retained earnings. Then underneath that, we have less unrealized loss on available for sale securities. Okay. Then we report the total stockholders' equity. Again, looking at the classified balance sheet as a whole, right? We have cash. We have our short-term investments. These are reported at fair value. We have our AR, less allowance for doubtful accounts, inventory, prepaid insurance. Here's our total current assets. Oh, by the way, then we have some investments, right? We have investments in stock. Again, they're telling us that it's less than 20% of the owned companies. We got to report it at fair value. We get $50,000. Then we have investments in stock that we record under the equity method, right? That's the 20 to 50% of outstanding shares that we own, okay? We report it as the investment in stock, 20 to 50%. And notice we say here at equity method or at the equity, right? We're utilizing the equity method, okay? We're going to skip over IFRS for now. So that's all I got based on stock, right? How to report stock. There's a lot here. There's a lot we need to know, okay? Again, when we run through the demo videos, we're going to reinforce what we just talked about, okay? So tune back in for our next video where we're going to go over how to report these trading securities or these available for sale securities or even the held to maturity securities. So tune back in for that demo video.